For more on the economy, Professor Yan Liang joins us, Professor of Economics, Willamette University. Good to have you back. You know, we were going to have an easy interview, and then this happened today, and I have to get this off my chest. The Fed chair, I think, set it up relatively nice. The markets kind of got what they wanted. There was no issue until Treasury Secretary Yellen started talking about this FDIC insurance, and basically, I guess, answering one of the questions, saying that there is no plan to increase the insurance to protect depositors, which is the exact opposite of what we heard not that long ago. They have to be on the same page. What's going on here?
I know, right? What a bummer. So I think, what Powell is trying to emphasize is that, SVB is an outlier, right? And so, they have very connected depositors. 88% of the deposits are uninsured. And so this is not going to be a case for many of the other banks. But I think, that is really an overconfidence, as we know that around 186, these medium-sized banks may have the same problem where if half of the depositors withdraw the deposits, they could come short with cash. And we also know nationwide, out of the $30 trillion deposits, 30% of it are uninsured. So I think without that 100% of deposit insurance on all the deposits, it's really difficult to really assume away that this kinds of problems won't happen to other banks. Not to mention, FDIC right now is really running low, right, on their loss reserves. They had, $128 billion. I think, they're pretty much running out of it. So I think that is definitely not a good news, and it's definitely not a confidence booster to kind of say, this bank run problem won't happen.
Well, I think it will happen again. I mean, we've seen that throughout history, right? I mean, hundreds of banks have gotten in trouble over the past couple of decades, even before the financial crisis, in the financial crisis, and even after the financial crisis, all the way up to even recently. If the problem is people move their deposits because they're worried about the insurance on it, then increase the insurance from $250 to $500 or even more. It would cost the banks a very nominal fee to increase that insurance. Instead of throwing hundreds of billions of dollars to save all these banks, they wouldn't need savings if people wouldn't move their money because they feel safe. I don't understand why the Treasury and the Fed can't get together and solve this issue. They wouldn't have a crisis if they just fixed this one problem.
Right. I mean, totally. Phil, we have to be careful because this could be easily a self-fulfilling prophecy. I think, the regulators, the policymakers are really trying to, boost the confidence through their rhetorics. But we all know there are a lot of holes in the argument, as you precisely pointed out, right? This is not something that we could simply assume away. There are a lot of reasons why they're not, charging higher, insurance premium, and therefore we will be able to cover all the deposits with the insurance. So I think, definitely that is a policy making, that's a legislative question. And I definitely think they need to think more carefully about how they wanted to, make the kind of insurance work. But I think at this point, really what they're having here is trying to drum up this idea that, we will have the Federal Reserve lending, right? And therefore we'll be able to help to solve these liquidity crises. And they were also hoping, this kind of bank run would not be a concerted sort of efforts on the depositors. But we all know, right, with, social media, with, what some people would call this is the Twitter-filled, bank run, and we just can't exclude that possibility.
So from what the chairman said today, Jerome Powell, talking about the markets, talking about the monetary policy, making sure there's enough liquidity in the system, but at the same time tightening, I guess, short-term rates, and then signaling to the market that long-term rates are going to be still an issue because inflation is still an issue. Okay, we all know that, right? That's not new information for any of us, and I think the market was generally okay with that. So my question to you is, the setup for the rest of the year, do you think he said the right things, and where does that lead us over the next couple of quarters now?
Yeah, I think he did indicated that, the rate high is probably going to be moderated because, once the banks are in trouble, they're going to also tighten their credit extension. So that could in some ways put a brake on the economy. So there might not be a lot more hikes down the road. So I think, he's saying that we need to look at more holistically and see how things go. But that said, I think really, using the sort of interest rate hikes to try to fight inflation, I think the remedy is really worse than the problem. And we also know, this is not going to be very effective unless you really crash the economy.
Right.
To be able to really fight the inflation, right? So we have learned this from history, just by hiking the interest rate and trying to have a soft landing, and in order to, solve the inflation problem.
So you might get your wish,
yeah.
right? Because you got the bank crisis, so the banks are going to loan less money. They're going to be more careful. Of course they are. It's obvious they're going to be more careful in loaning money out to people. You have people who are saving money because they're worried about losing their jobs. So the economy is naturally going to slow itself down. I don't think raising rates, whether 25 or 50 or even 100 more basis points, is going to solve the inflation problem. If the issue is that the economy is too strong because we're all getting paid too much, we're all spending too much money, at the end of the day, that's the issue, is that the economy is not weak enough, so he has to drive this weakness into the economy. It just seems like what you said, the remedy is part of the problem. So then what is the solution then to the inflation? Or maybe we just give up and live with higher inflation.
Right. So I think that is definitely not their policy logic, right? They would not tell you that they are trying to engineer a bank crash in order to slow down the economy and therefore the inflation. So the argument has always been, let's try to soften, the heated labor market. But, all truth told, even though the jobs are being added, but the workers' wages, when you look at their real weekly earnings, they have been down by 1.2% from last February to now. So it's really not that wage price spiral that they're trying to, hike the interest rate to cure. The problem, I think, one of the interesting things is when you look at the profit margins of corporations, non-financial corporations, it's up to 16% for that gross profit margin. Last time we saw this number, that was right after the Second World War. So for a long, long time, corporations are not able to hike the prices and generate that much of profit margin. So I think there's a question about, do we really want to continue to hike the interest rate to crash the economy in order to, fight inflation? Or maybe there are other tools, right, that we can somehow rein in the pricing power.
I, for one, would rather have all my friends have jobs and live with higher inflation than to have unemployment spike. But that's just my opinion. Professor, always good to see you. Thanks for the analysis. Thank you.
Thank you.